Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is the XLE. That's an ETF that tracks the energy sector. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
All right, Lindsey. Well, I have a chart of the S&P 500 index up, and for the first time in quite some time, it doesn't look too well. We've talked a lot about the 50-day moving average, and I'm highlighting it here in red. It tried its best to hold the market up, but now we've had 3 days where we have 3 red candles that are below that 50-day moving average. And then the channel, I haven't touched this channel since I basically set it up a couple of weeks back, but it starts in May and we're in danger of breaking through that. It's really struggling to keep the S&P 500 index above that. And today I've actually added the 100-day moving average. I kind of thought that was relevant. It looks like it might be providing a little bit of support. Not a lot of people look at the 100-day moving average, but I figure that if we breach that 100-day moving average, that means we've broken through that bottom channel, and then we're looking at the 200-day moving average right around the 4,100 level in the S&P 500 index. I think that may come into play if that happens. So if we go all the way back and look at the 200-day moving average, we broke above it in June, and as usual, it struggles to break above that 200-day moving average when the market first does. Came back and touched it a couple of times. And then since July, we haven't even seen the 200-day moving average hasn't even been in the purview, if you will, of the charts overall. So for the first time, people are talking about that 200-day moving average. The sky is falling type mentality. We saw it a couple of weeks back, and a lot of people were nervous about the market. We had the VIX run up, which we're going to talk a little bit more about the VIX here in just a second. But when we got that retracement, we got that pullback in the marketplace, everybody let out a sigh of relief. But here we are again. We're heading into October, September and October. Volatility has always been a concern, and it's proving itself to be a concern again this September. So NASDAQ, I'm going to pull up a chart on that, Lindsey, not looking much better. Very similar. As a matter of fact, a little bit uglier than the S&P 500 index. So what do you see going on in the marketplace this week?
Yeah, this isn't a pretty chart. You showed the S&P 500, not a pretty chart today. You mentioned the 200-day moving average on the S&P 500. I just wanted to quickly jump in and point out the fact that that is actually almost a 10 percentage point drawdown from the 52-week high. So the market's really been grappling with the fact that we haven't really had any major sell-offs, so 5% or more, or corrections of 10% or less this year. And if we get down to that 200-day moving average, it feels like it's a really far place to be. That's where we would be. So that just kind of putting things into perspective. The last couple of days haven't felt good. This morning certainly doesn't feel good. And then you've got a chart of the NASDAQ. We're seeing the tech sector really drag down all the
all the indications. All right. It looks like Lindsey's
an economic environment.
Oh, you're back. Okay, Lindsey, you were gone for
Am
a
I
second.
back?
Welcome back.
Sorry, technical difficulties. I'm actually in the office today and still the internet not so great. Anyway, I was talking about the 10-year yield moving higher. It's been moving higher a lot faster than most people had anticipated. Usually a higher yield means we're entering in a economic recovery, especially off of low levels. But last week we had that Fed meeting, and we saw the Fed talk about plans to begin tapering their bond buying, their quantitative easing programs, which we thought was priced somewhat into the market, which was driving rates higher. But this move is a lot faster than people had anticipated. And that weighs on sectors like the technology sector. So you see the NASDAQ under pressure because higher interest rates, that it can ding future cash flows for high growth companies like the FANG names or tech or communication services in general. So you've got some pressure in that area today. So we're going to keep an eye on that. But also, there's a lot going on this week, a lot weighing on investors' minds, especially a lot happening in Washington, D.C. Congress is debating a lot of different bills. You've also got today, you've got Treasury Secretary Yellen and Fed Chair Powell in front of some members of Congress talking about the state of the economy. Yellen out there this morning saying that the debt ceiling needs to be raised or we're going to risk defaulting on our debt. I think most investors are of the belief that we're going to get to a solution before that October 18th date that she mentioned, where that's the drop dead date. Whereas if the ceiling isn't raised, that we will default. So I think investors feel a little bit better about that, but it's still a risk at this point in time. There's obviously a lot of contention. Usually when there is gridlock in Congress, that can be a good thing for the market. It usually moves higher because you're not going to see a lot of change, but we need the budget to be passed. We need the debt ceiling to be addressed. So there's a lot of hot topics right now in the here and now. And of course, we're in the month of September, going into the month of October, which are both, pretty weak months from a seasonal perspective for the stock market. So you've got investors with a lot of angst currently. So there's fear in the marketplace. But I will say, Callie Cox, she crunched some numbers for me. I've talked about the 10-year making investors nervous today. We've seen the fastest move up in the 10-year yield in the last 4 months. So that is a little bit nerve-wracking. But the good news is when the market sells off, when the 10-year is moving higher, usually a month later, you see the market start to move higher. So this might just be a little recalibration by investors to review their portfolios and prepare for higher interest rates in the future. So now that being said, when we see anxiety rising, Brian, that usually means the VIX is rising, and we're certainly seeing that today. I think it's above 20. At least that's where it was this morning when I looked. What are you seeing in the VIX? How are investors feeling?
All right, so I'm going to highlight the TNX, which is the interest rate on the 10-year. We see it at 15.25. It's up to over 2.5% today. So just to emphasize what you were chatting about there in the increase in the interest rates on the 10-year. The VIX is up 5 points today. More importantly, it's broken through that 20% level. So if I look at the VIX, we're at 2381. And if we go out to the November, December, January contract, it's trading right around 23 to 24. So interesting to see the spot index, the actual VIX, trade at the same levels as the futures contract. A lot of times, if we get above that level recently, that usually means we got a big downturn in the short term. So now, one thing that I do find interesting here is that we haven't had a huge spike up, even though if I look at the chart is a little bit more scary than it was last week when we had the big downturn and we saw the VIX actually spike up to 28%. So right now we're trading right around that 24 level, right where the futures in January and December are trading. We haven't had the huge spike up to the upside. So maybe the marketplace feels okay about what's going on, but the chart is telling us something a little bit different. So we're getting a little bit of conflicting information. I would have expected the VIX to actually trade a little bit higher today, adding a little bit more nervousness to the marketplace. All right, so now we do have one sector that's green. There's not many that are out there, but if I'm looking at the XLE, which I'm showing here on the Ally Invest ETF research page, we actually see we're up a fraction today on a fairly big down day. Let's talk a little bit about the energy sector.
Yeah, we decided to talk about the one sector that is actually green today, and that's the energy sector. And Brian, I know you got a chart of this thing up. The energy sector is the best performing sector in the S&P 500 on a year-to-date basis. it is up like 35%. But that being said, this is coming off of a year, 2020, where it was the worst performing sector in the index. It was down 37%. And we're still struggling to get back to pre-pandemic levels. So back in January of 2020, we saw the XLE much a bit higher, 12.5% higher than where we're at today. So that says there could be room to run potentially. But what's driving this move higher? Well, in the last month, you've seen oil prices, WTI, West Texas Intermediate oil prices up about 11%, and the XLE is up about the same amount. And Brian, I know you're scrolling down there. The XLE, it mimics the S&P 500 energy sector. So the two largest holdings in the XLE are Exxon and Chevron. You see there making up about 44% of this ETF. So they're going to be key drivers. They're also the largest components of the S&P 500 energy sector, so that's not surprising. But when you look at the chart of the XLE here, like I started to say, really being driven by higher oil prices over the last several weeks. And the reason for that really is a supply-demand constraint situation. Part of that being driven by what's happening in the gas area. The supply there has been limited. So the idea is that people are going to move to using oil over gas as supply constraints arise there. You also have China putting on restrictions of emissions. So people are moving away from coal into gas also there. So there's a lot of things going on. And then there's also the thought that demand is rising. You've heard OPEC and others talk about demand and travel expected to increase into 2022, which means that supports higher oil prices as demand rises. So there's just a lot going on there helping to support higher prices in the energy complex. And that's benefiting the energy sector. Also, though, when you look at the energy sector, earnings for energy are very highly correlated to oil prices. And so it's natural to see energy earnings move higher as oil prices move higher. And that's exactly what we saw. We're coming into third quarter earnings season. The third quarter is almost over. And as oil prices have moved higher, we've seen energy earnings move a lot higher, actually moving higher than any other sector in the S&P 500 index. So that also helps support higher prices in the energy sector. And then also when you look at a lot of energy analysts will look at the differential between the rise in oil prices versus the rise in the XLE. And that has far outpaced, the oil prices have far outpaced the rise in energy, the XLE ETF. And so there's a gap there. So that says there could be some opportunity. It's interesting that oil prices, Brian, by the way, they're able to move a lot. They've been able to move higher as the dollar has strengthened. So as the Fed talked about the economy recovering and oil prices improving on demand, a higher dollar can sometimes offset the positive or optimism about the economy. And we just haven't seen that. You've also seen energy credit acting really well. You know, there's a lot of people out there. I did see Kathy Wood, by the way. She tweeted earlier today about how oil prices should be going a lot lower in the future as electric vehicles make a bigger mark and become a bigger part of the auto industry. It just doesn't seem right now the way that supply and demand is aligned, and the trajectory for the electrical vehicle market is projected. It's going to take a little bit of time to get there. So I think that's why you and I always talk about options. You know, there's always two sides to every trade. And right now it seems like there could be a short-term opportunity here, especially, like I said earlier at the beginning, especially as we look for an opportunity for the energy sector to reach those pre-pandemic levels, which is one of the very few sectors that hasn't been able to do that. So that's why we're looking at it today, Brian. What do you think from an options trade perspective? What are you saying?
Well, overall, just to kind of feed off of what you were talking about, Ford is definitely trying to stick their foot in the water. They might be sticking their whole body in the water as far as energy vehicles are in. They're making $11 billion spend. They're going to be making they're going to be building a few factories in the U.S., which is just overall, they're putting a big bet in the EV space overall. So I find that interesting. And we actually talked about Ford as an EV in one of the stock plays of the day a few months back overall. So as far as the XLE is concerned, we're going to try to look at, we're nervous about the marketplace. So once again, we're going to kind of look at a FOMO trade, fear of missing out. We're not going to go all in. We're not going to go deep in the money. We're going to have a bullish trade, but we're going to buy a fairly inexpensive option contract. We got a big down market today. This is one of the only industries that is showing in the green today. So we're going to do what's a long call. And I'm highlighting that inside the options playbook right now. Very simple. We'll go a little bit out of the money, but we're going to give ourselves some time. We definitely want to get through September and October. And we're going to go all the way out to January of next year. So let's look at this week's paper trade. And as always, it's not meant to be a recommendation here on the stock play of the day. We're just trying to learn. And we're looking at, this is what the marketplace is showing. What's one of the 40 strategies inside the options playbook that might be pertinent based off of what's going on in the marketplace right now? Now you can apply it to your underlying stocks, your forecast, whatever sector you might want to be in, considering where the marketplace is at right now. So we're holding steady here in the XLE, up 26 cents today. Overall, bottom line is it's in the green, and that's probably more important than anything. We have many different expirations to choose from, and we have very liquid markets in the XLE, which always helps out when you're trading options. So we're going to go all the way out to January 21, the third Friday in January, 115 days away. And a lot of times if we're a little bit more bullish or just overall bullish on the marketplace, we would go deeper in the money, buy an in-the-money option contract that acts a lot more like the stock, as opposed to going a little bit out of the money, which we're going to do today because of the nervousness. We're not going to pay as much, so we're not going to have as much as at risk on this position. But bottom line is the XLE is trading at about a 30% implied volatility. Now, think about that. The S&P 500 index is trading at a 23% implied volatility on a 30-day basis, right? Our option contract that we're looking at is right around 30%. So volatility isn't that bad in the XLE overall relative to the rest of the marketplace. So we're going to buy an out of the money option. And if anything, I want to err on buying too much time. So January 21st, that gets us out into the new year. You might even want to go out a little bit longer in time, but I didn't want to spend too much. So time is money. So the further we go out in time, the more costly that option contract is, which means we have more overall risk. So if we're buying one contract, our risk is going to be limited to that premium that we paid for that option contract. So if I scroll down to the LI Invest strategy workvests inside the option chains here, we see that very simple trade this week. We're just going to be buying a little bit out of the money. We're not going to go too far out of the money. Call option, January 21st expiration, 55 call. We still get some decent delta here. We're trading at a 44 delta, which implies that if the underlying stock goes up 1, this option contract should go up approximately 44 cents. So we're getting a lot of stock price representation by this option contract. And if I put it in the right rail over here, well, then it becomes the official paper trade for this week. So we're looking to buy to open on our paper trade this week. We're going to buy to open the January 21st, 2022 55 strike call. We're eliminating our risk. Now, this is the thing about the option contract. If you were thinking about buying 100 shares of XLE, we're just going to buy one option, maybe 2. If you want to get a little bit frisky, but we're not going out and buying 10 options, right? We're not trying to use the leverage factor here and buy as many as we can in our account. Now, if you take that approach, well, then it is a limiting risk trade in that the maximum that we can lose on this trade, and if we fill it to midpoint, I'll put that in. Actually, the market's fairly decent. We'll just talk about the natural, just where the current market is at, which is $2.65. So our maximum risk would be $265 plus commission on this trade. And I'll even run on down and we'll look at the profit and loss graph here. Let me remove the right rail and we'll zoom in a little bit. Okay, so this is where the underlying stock is at right now. This is your profit and loss graph as of today, that colored line is. At expiration is the dotted line. So we want the move to happen sooner than later, but we still are getting a lot of acceleration, and that's being represented by that delta being right around 44 in this instance. So over the next couple of months, we see how the markets are playing out, see where we're at. This is the one sector that has been strong overall. And we've been looking to talk a little bit about energy here, just in general. It's one of the sectors we haven't actually focused on. And I think the timing is right to talk about it on a big down day in the marketplace, specifically in the NASDAQ and the tech stocks overall. All right, Lindsey. Well, that's the paper trade for this week. Do we have any questions? If you have any questions, please make sure you put them in the chat box. Lindsey and I are going to be around for a few more minutes, and we'll be happy to answer them overall. Right now, I'm not seeing a ton in that chat box.
Yeah, I don't see anything right now, but I know we've got some great people watching us, and I'm sure there's something on their mind that they can ask us about. We're open to whatever's on your mind, so please feel free to put it in the chat box on the right. We should have reminded you sooner in the show. That's our fault, but we're happy to have you here, especially on a day like today when the market really is seeming to fall out of bed this morning on the back of those higher interest rates. Like I said at the top of the show, just remind everyone that usually when you see a move this swift in yields and the market is down on the back of that, a month later, the market can be higher. So that is something I just want to remind investors, stay calm. Volatility is a normal part of markets. Typically, you see anywhere from, you can see about 5 to 10% pullbacks a year. That's absolutely normal. On average, the greatest pullback in any given year has historically been about 14%. And like we talked about earlier, Brian showed a chart of the S&P 500, highlighting that 200-day moving average as the potential next risky level to the downside. That's only a 10% pullback from the 52-week high in the S&P 500. So while it looks scary on the chart, it feels scary when it's happening very quickly. If we get to those levels and can hold those levels, the market can move higher. I mean, the reality is, Brian, I put my fourth quarter outlook out today, and I talked about what the performance could look like in the fourth quarter. And the title of my report was Going Against the Grain, because investor sentiment has turned so negative over the course of the past 3 or 4 weeks. You've seen pressure enter the marketplace. And I am probably always been a glass half full type of gal. But in this type of environment, I always go back to the consumer. We have seen some weakening economic data over the last several weeks and months, and I expect that could start to turn around. In fact, if you look at the Bloomberg Economic Surprise Index, you've started to see economic data improve a bit, and I think that was what the 10-year yield was signaling when it bottomed at the end of July and started to move higher, especially as the Delta variant has begun to run its course and cases have started to decline a bit. We're starting to get some questions in the box here, Brian. So let me just turn to that real quick. But be sure to go to the community hub, which is ally.com/do-it-right for my fourth quarter outlook if you want to learn more there. But what do we got going on in here? William Mitchell, if you're going to do a spread, what strike would you consider, Brian?
Definitely. Great question. Because I did consider a spread overall. I think in this instance, because we're going out of the money a little bit here, I was kind of thinking that I would rather wait a little bit before I sold the other call option on this spread. Want to see where we're at overall, see if we can get a little bit more of a bump up in the XLE, and then think about legging into the spread. I know that I've said this before, that doesn't make you a spread trader, right? Overall, you're still a long call trader because You have all the risk of the marketplace if it doesn't work with you. But if I were to do a spread, it's all about where I would target on the upside. So if we go back now, I was highlighting Lindsey's outlook here actually while she was chatting. I pulled it up. So if you want to take a screenshot of it or whatever, you can actually grab that URL. I don't have the ability to put it in the chat box right now, but just thought I would highlight it because a lot of good work went into this piece. And one of the things that Lindsey was saying that really caught my ear was about a month later after interest rates are increasing. Interest rates going up really doesn't necessarily mean that the market should go down overall. Sometimes it's a good thing. The economy might be picking up a little bit overall. So with that said, let's go in and finish this question. I digress. If I were to look at it, I would kind of look at where the expected move is. A lot of times you just try, because you're trying to guess like where you think the market may go. So we're at 53. So if I buy the call, it's 350. If I buy the put, it's $4. So we're talking about a 7-point move. We're 2 points up. If we go 7 points, that would make it right at 60. So I'd probably, let's see where that 60 call is at. If I was going to do the spread, 58, let me add a couple more strikes to it. Okay. If I were to look at a spread, I would be looking at right down here, right around that 60 strike. It looks like we'd still get some premium. My computer's moving a little slow right now. There it goes. Yeah, you're looking at bringing in $1 to $1.23. Not bad, but that's within the expected move, right? In other words, if I look at the long straddle on that 53 strike call, it's saying that if I buy the call and I buy the put, that a 7-point move is feasible before that expiration date. So if I were to just not look at the technicals of anything, and I'm just using what the option prices are telling me, I'm going to sell a call at a spot where the marketplace thinks that it could get to. Now, it doesn't have any regard to direction. I want to emphasize that. Long straddles, you're buying a call and you're buying a put. It doesn't care where it's going. It's just saying that if you're willing to pay $7 for it, that means that the marketplace thinks that a $7 move is feasible by that expiration date. So I'd look at selling the 60 based off of that. Market's at 53, add that in, you got 60. That's simple. So that's just a quick and easy way to target a call that you might want to sell against it. But in this instance, we're limiting our risk enough by just buying an out of the money call option. If anything, I would think about maybe a month or so later to sell this call if the market goes with me, and I'll get a little bit more on that position overall. It's a little bit long-winded, but yeah, I was actually thinking about a long call spread today, but I laid down until the urge went away, basically.
I love that, Brian. We got 2 minutes left. Love it that all the questions that are coming in. One of the questions I always like that you get, I'm glad Kids and Cars asked, is, Brian, why'd you pick that expiration? That's always something I like for you to answer. Yeah.
And like I said, I considered going a little bit further, but I really wanted to limit the risk. I wouldn't mind actually going out to February or March in this trade overall. But if we get out too far in time for the stock play of the day for a paper trade overall, then you're obviously increasing the price, which increases your overall risk. $265 for one call option here. That's your maximum risk on this trade. So I decided to just go out until January, get through the volatile months of September and October, and try to get into the new year. So that's why I picked this strategy, but I don't mind going further out. But if I'm buying out of the money option contracts, I always want to err in having more time than less, because out of the money option contracts can be tricky in that you really need it to get to your strike price in order to be profitable on those type of trades. A small move to the upside might not always be beneficial just overall to your long call option if there's too much time decay before it happens.
Got it. Well, Brian, we did get a bunch of extra questions, but we're out of time, unfortunately. So Derek, Gordon, Wayne, nice to see you again, Wayne. Make sure you guys all come back on Friday when Brian reviews this trade on Friday at noon at the Ally YouTube channel right here where you're at now, and hopefully can answer some of your questions then. And if not, we will be back next Tuesday for the next stock play of the day at noon on Tuesday. That's all we got, Brian.
Yep. All right, everybody, click subscribe, ring the bell, and we'll see you this Friday.